Hey everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. The markets over the past months have taken twists and turns that you may have never seen coming. Investors are beginning to question their strategies and thinking about what can provide them with an edge over the market. But in all this turmoil, perhaps it's time to go back to the basics, which is the topic of today's video on The Little Book That Beats the Market by Joel Greenblatt. The book is simple and easy to digest, and yet very powerful when it comes to value investing and stock picking. Greenblatt's account of how to beat the market is a refreshing read, and considering today's time where everything is crashing, it may be well worth revisiting some time-tested principles. So without further delay, let's dive in! Joel Greenblatt is the founder of the Gotham Funds. He's made millions from the stock market and taught about investing in the top universities. He wrote this book as a way of educating his children in 2005. Greenblatt believed that if he can reduce complex investing knowledge into simple principles that even kids can understand, then he can share his secrets of success in the stock market with anyone. Greenblatt has a stellar track record and has consistently beaten the market for over 25 years. Now let's get to our top 3 takeaways. Takeaway 1: no one can teach you to beat the market. The first insight from the book is strikingly shocking. He says that no one can teach you to beat the market. In his 30 years of experience and 14 years of teaching the principles of value investing, Greenblatt came to the conclusion that beating the market is not something ordinary, and it cannot be taught, but can only be experienced. He believes that only you can teach yourself how to beat the market, and that starts with reading books that provide sound investment advice. In his own words, Greenblatt says, "The stock market is an opportunity factory. It's a place where you can buy a business for a lot less than it's worth. Or you can sell a business for a lot more than it's worth. Or you can overpay and undersell. If you want to become an outlier, then following conventional standard advice will not help you. Greenblatt's magic formula, which is based on certain principles, can consistently provide the results that you're looking for." Takeaway 2: the magic formula. So, what is the magic formula? It's a pretty easy to understand, rules-based investing strategy that relies more on financial discipline than financial engineering. The magic formula provides the handrails to help find good investments even if the person does not know exactly what they're doing. However, knowing what they're doing is important because, in Greenblatt's words, although in the short term, Mr. Market bases its prices on emotions, in the long term, Mr. Market prices according to value. If you want the magic formula to work for you, you have to take out the emotional part of yourself and go through the strategy even when things are not looking so good. So how does this magic formula work? Greenblatt uses 2 financial ratios to present the formula. The first, earnings yield, is related to earnings per share divided by current stock price, and second, return on capital, is related to earnings produced divided by capital used. Once you have these 2 ratios, all you need to do is to rank your stocks and calculate their combined ranks. The stocks with the highest combined number are likely better investments. Greenblatt believes with this simple formula, you're on your way to buying good companies on average and cheap prices on average. Takeaway 3: stay the course. Greenblatt believes that in the short term, the market is not predictable and often based on emotions coming from the news media that you have no control over. In his own words, Mr. Market is manic, depressive in the short term. You can buy and sell stocks at crazy prices. Over the long term, Mr. Market eventually gets it right. It's the short term that gets people in trouble. So having a long-term view on investments is likely to pay off better. Greenblatt advises that you stick with your strategy for 2 to 3 years to get above average returns. This takes a strong mindset and a strong stomach. Follow the discipline to stay the course and not to sell until your long-term goals have been achieved. Also, this is why it is key to understand what you own. If you don't know what you own, you may be tempted to sell when things are going down. Greenblatt summarizes this very well by saying, Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning matchstick. You may live, but you're still an idiot. Alright everyone, that's it from us. I hope you enjoyed these insights from the book. Thanks for watching, and don't forget to smash that like button and subscribe for more such videos.